Executive Director of the Wisconsin Potato and Vegetable Growers Association. And I would like to thank our sponsors of today's seminar, Lincoln Financial Advisors Agribusiness Services, along with Hush Blackwell. We have three speakers today, Art Littlefield, Jeff DeWald, and Rhett Holland, who will be providing some tips on year-end tax planning. And we'll be hearing from those folks shortly, but I do have a couple of housekeeping items that I'd like to let everyone know about. Please keep your microphones on mute to avoid any background noise or feedback. We will be having questions and answers at the end of the presentation. Now, if a question does come up during a presentation, feel free to use the chat feature to ask your question. The chat feature is in the lower right-hand corner of your screen. You click on it, and you can direct it either to a specific person or to everyone. Now, you could also use the raise your hand icon if you would rather just speak your question. And then we will have our host, Bridget Evans, let us know that there's a hand up, and she will unmute you and allow you to ask your question. But again, we would prefer if you can hold your questions till the end. We are planning on having about 45 minutes of presentation time, followed by 15 minutes or so of questions and answers, but we can use up to our full 90 minutes on this webinar as needed. This meeting is being recorded, and a link to it will be posted on the WPVGA website, which is www.wisconsinpotatoes.com, and that should be available by the middle of next week. And so with that, I would like to introduce you to our three speakers. I'll just give you a brief background of each. Art Littlefield is an estate and succession planning specialist. He's based in Naperville, Illinois. Please don't hold that against him. He has more than 35 years of experience in the financial services industry. And Art is passionately committed to working with agribusiness owners and their families to assist with succession, legacy, and tax minimization issues. Jeff DeWald is also an estate and succession planning specialist based in Boston, Massachusetts. Jeff has spent the past 39 years working with successful farmers, growers, and owners of mid-market businesses, advising them on business succession, retirement planning, estate planning, and wealth management. Jeff is a founding member of the Business Intelligence Institute, a group within Lincoln Financial Advisors, which focuses on business owners. And then Rhett Holland is a partner in the law firm Hush Blackwell, based in Milwaukee, Wisconsin. Rhett represents clients in a full spectrum of estate and business succession planning matters, ensuring that they and their families are protected for the long term. He creates customized estate plans that transfer wealth and family businesses to future generations in the most efficient manner possible. And so with that, I'd like to turn it over to Art, and take it away, Art.
Thank you, Tamas, for the great introduction. We need to go through the disclosures first. Jeff DeWald and Art Littlefield are registered representatives of Lincoln Financial Advisors Corp. Lincoln Financial Network is the marketing name for the retail and financial planning affiliates of Lincoln Financial Group and includes Lincoln Financial Securities Corporation and Lincoln Financial Advisors Corp., broker-dealers, registered investment advisors, and members of FINRA and SIPC, insurance offered through Lincoln affiliates and other fine companies. Lincoln Financial Group is the marketing name for Lincoln National Corporation and its affiliates. Lincoln Financial Securities Corporation and Lincoln Financial Advisors Corp. And its representatives do not provide legal or tax advice. Attorney M. Rhett Holland is not affiliated with Lincoln Financial Network. The current transfer tax regime was established under the Tax Cuts and Jobs Act, which was passed in December of 2017. The exemption is $11,580,000 per person, which equates to $23,160,000, $23,160,000 for couples. The same limits also apply for lifetime gifts. And in addition, there's a 40% federal tax rate on any amounts in excess of those numbers. At death, there's a step up in cost basis, meaning that your heirs will inherit your assets at the value when you died, not what you paid for them. And that is a very important point that will be addressed later. Unfortunately, we forget that the TCJA is not permanent. There we go. Thank you, Bridget. The tax laws almost never are and sunsets on December 31st of 2025. As you see on the slide, under current law, the available transfer tax exemptions will be effectively cut in half starting in January of 2026. So under TCJA, clients have a 5-year window to take advantage of current exemptions. Jeff, how about if you tell us what might happen in the future?
Thank you. Sorry, I was trying to find the unmute button. Thank you, Art. Appreciate that. The challenge is that we know that the current law is scheduled to go away in January of 2026. Unfortunately, there's no guarantee that we have another 5 years of this current tax regime, which is really the most consumer-friendly tax law that we have had, at least in my lifetime. Why could things change sooner? Well, first, we have a massive, massive cost of recovery from the COVID pandemic. Those taxes, those expenses need to be paid for from someplace, and raising taxes is the most logical way to do that. So regardless of who wins the election in 2 weeks' time, we are likely to see some type of tax increase coming down the road just to pay for COVID. Add to that we have the election coming down the road, and we really have no clarity over which party is going to be voted into office, and maybe just as importantly, which party will control the House and the Senate. As you know from watching the evening news, there are increasingly vocal segments of society that feel that rich people don't pay enough taxes. And congratulations, if you're watching this seminar, in a lot of people's minds, you are rich. You may not feel that way, but in the minds of the general population, you are. And so you are a very easy target for the segments of society and the segments of Congress that want to increase taxes. Bridget, next slide, please. So what are we looking at? The simple answer is we really don't know. If the Democrats were to win the White House and control the House and the Senate, what are the potential things that could happen? Well, we have President Biden's proposals, which have been articulated, and by the way, they are pretty much the same as Bernie Sanders' tax proposals. We don't know if that's because that's the way that Biden really feels is a fair way to tax people, or if that was a card thrown to Bernie Sanders to get him to agree to let Biden be the Democratic nominee. But the Sanders proposals are very similar to what was called the Green Book proposals. Those were the tax changes that the Obama administration had recommended. And so under the Green Book proposal, Art talked about how the current estate tax exemption, which is 11.5 million in round numbers, will automatically decrease to 5 million indexed for inflation when the current tax law sunsets. The Biden Green Book proposal would make that reduction much more dramatic, taking it down possibly as low as $3.5 million per person, or $7 million per married couple, with that change taking in effect as soon as January 1st of next year. So that is a real game changer for a lot of business owners, not just those who are involved in agriculture, but all of the other closely held businesses around the country. Lifetime gifts, which are currently the same as the estate tax exemption. In other words, just like you can give away $11.5 million tax-free at your death, you could give that same $11.5 million tax-free during your lifetime to your children, your grandchildren, maybe a trust for your children and grandchildren. The Green Book and Biden proposals would reduce that down to $1 million for lifetime gifting. So that significantly complicates issues like how do we transfer the operation down to the next generation. The tax rate on the amounts above the exemptions would also increase. It's 40% today, and under the Biden Green Book proposals, it would jump to 45%. The biggest change, as Art alluded to, is the proposal to eliminate the current step up in tax basis. Bridget, next slide, please. All right, so what does this mean for a family farm operation? We've tried to put some math to the proposals. So we have hypothetical situation, the Smith family, who operate Serenity Farm. They farm 1,500 acres in the Central Sands area. These are fictitious people, by the way. If the land is worth $10,000 per acre, the land alone is worth $15 million. Add to that the crops and storage, the equipment, the maintenance facility, the storage facilities themselves, offices, so on and so forth, everything else that goes into a successful operation. And the combined value of Serenity Farms may be $20 million. Under current law, if Mr. and Mrs. Smith passed away today, there would be zero federal estate tax. In 2026, when the Tax Cuts and Jobs Act sunsets, there would be an estate tax of $2,450,000. And under the Biden Green Book proposals, that tax liability would skyrocket to $6.25 million. It's worth emphasizing that those taxes must be paid in cash within 9 months of death. The IRS won't take potatoes that you have in storage. They won't take your harvester. They want cash on the barrelhead. And in many families, that liquidity crunch is really dramatic, particularly if, like many of the farm families we work with, you have some children who are coming into the operation and other children who may not be coming into the operation. Bridget, could I have the next slide, please? So what is this thing about step up in cost basis and why should we care? Under current law, estates get a step up in cost basis for all of your assets for the value as of the date of death. Let's take it and look at an example of the Smith family and what the step up in cost basis means to them. If we have the 500 acres in Central Sands that they paid $2,500 per acre for, their cost basis in that land is $1,250,000. If the family no longer wants to continue the operation and they sell the land after mom and dad pass away, the cost basis of those acres would be stepped up to the value at the date of death. If the date of death value is $10,000 per acre, the cost basis in that land rises up to $5 million, and the heirs would not pay a penny of capital gains tax if the land was sold after mom and dad died. However, if we have this regime where the cost basis step up is eliminated, the family would report a capital gain upon sale of the land equal to the current market value, what it was sold for, versus what mom and dad paid for it 20 years ago. And in this scenario, that is a $3,750,000 capital gain, which would generate probably about another $1 million of income tax on top of the estate tax that the family had already incurred. Bridget, next slide, please. It's important to remember that right now, these are just proposals. We don't know what changes, if any, may happen to the Internal Revenue Code, either because of COVID or because of the election. However, we do know what the laws are today, and we do know that there are some things that you may be able to do to lock in today's favorable tax treatment, provided that you act before the end of the year. Red is going to describe some of these, but I want to point out that the time to start considering them is sooner rather than later. Everything has a trade-off. There are some important considerations with the strategies we will discuss today, and you really don't want to be waiting until the week before Christmas to be having the conversation with your family and with your accountant and your tax advisors, and potentially with our team as well, about what types of strategies may be appropriate for you. These are important decisions, and it's worth reemphasizing that assets lost to taxes today are lost to your family in perpetuity. And over the course of your children's lifetime and your grandchildren's lifetime, $1 million in taxes that you may save through proper planning today could result in $5, $10, $15 million of additional wealth preserved for your heirs. So thank you. And now, Rhett, I will turn it over to you, and you can tell us all the really smart stuff that our clients can do.
Sounds good. Thanks, Jeff. Well, hello, everyone. I'm happy to be here with you today. As Jeff and Art both mentioned, the landscape is potentially changing in early next year. 2020, I think unprecedented has been the word for everything this year, and I think that's going to continue from the tax planning perspective for the next couple of months. Bridget, if you could go to my first slide. So what are you supposed to do knowing that these laws might change in 2021? It's a pretty stark difference between December 31st of 2020 and January 1st of 2021, depending on what happens in the elections in a couple of weeks. As Jeff mentioned, the same estate could pass to family members in December of this year with 0 estate taxes. And in 2021, that estate would have to pay $6.25 million to be transferred to the same family members. So when you think about your own plan, you need to have a plan in place that will work for you and your family under multiple different scenarios. That includes your sort of long-term succession plan, where you think of leaving or exiting your business or farm on your own terms and on your own timeline, as well as your estate plan. The estate plan governs the distribution of your assets upon your death, which could occur before you have an opportunity to actually execute on the long-term plan. So when you think about what your options are before the end of this year, from my perspective, what you want to do is make sure that the steps you take today do not negatively impact your own financial security, your own lifestyle, and your own ability to implement your long-term plan in the future. I think flexibility is key. Before we kind of jump into the specific strategies that you could implement before the end of the year, I thought we could just touch briefly on how we approach the planning process at Husch Blackwell, just to give you a little bit of context. We think of estate planning as a 4-step process. The first step is getting your core estate planning documents in place. Those are the documents that state how you want all of your assets to be distributed upon your passing. Typically, that would include a revocable trust, wills, powers of attorney, advance directives, and if you live in Wisconsin, a marital property agreement. Once you've got the core plan in place, the next step is to think about what we can do to reduce that potential estate tax exposure. In that regard, the first thing that we would do is look at ways that we could discount the value of your assets. So this whole notion of the estate tax is imposed against the value of your assets upon your passing. So what can we do, on paper at least, to reduce the value of your assets that are subject to that tax? Typically, we utilize closely held business entities to achieve that discounting, potentially through recapitalizing existing businesses that you may own to create voting and non-voting stock. Maybe we form new entities, or if you own a substantial amount of real estate, we fractionalize that real estate ownership to try to depress the value. The idea being that we want the sum of the parts to be less than the whole from a valuation perspective. Once we've looked at the valuation side, the next step is to determine how can we move assets out of your estate today. And that's step 3. First, can you move assets out of your estate using the tax laws that are in place today so that all of the future growth on the assets that you give away is outside of your estate for tax purposes? Secondly, if after you have gone through the process and decided what assets you're willing to transfer, if any, the next step would be to make sure that your family has liquidity available to pay that estate tax liability if there is one due upon your passing. As Jeff mentioned, that estate tax is due within 9 months of the date of the surviving spouse's death, and that's due in cash. So you want to have a plan in place to provide for the payment of that tax so we don't end up having to sell assets in an environment when you may not want to do that. And then finally, once you have gotten your core documents in place, you've transferred assets to the extent you're willing to, you've covered that liquidity issue, the final step would be charitable planning. So if you've provided for your family to the extent that you want to, the final step is to look at what you can do from a philanthropic standpoint. That could be outright gifts, gifts to donor advised funds, charitable trusts, or private foundations. So let's assume that you have your core documents in place. The question is, what do you do next? In a scenario where you may be subject to estate taxes in the future, your family may have to pay estate taxes upon your death, but you don't feel comfortable with the idea of giving away all of your assets because you might need them in the future. Of the various strategies that you can put in place to transfer assets and optimize the amount of assets that go to your family free of estate taxes, typically those involve the use of an irrevocable trust. And an irrevocable trust is a trust that you can create during your lifetime or upon your death, where you name a trustee, and that trustee is obligated to manage those trust assets for the benefit of your beneficiaries. So typically what people do is create an irrevocable trust, transfer assets to that trust during their lifetime that uses some of the exemption that is available for lifetime gifts. And then the assets that are in the trust will not be subject to estate taxes upon your death. So you've transferred assets out of your estate to a trust. The assets in that trust are available for the benefit of your beneficiaries. And the assets in that trust are not subject to estate taxes. Now, the important caveat to that is that you cannot create an irrevocable trust and transfer those assets out of your estate for estate tax purposes and still be a beneficiary of that trust. You have to actually give the assets away to take advantage of the gift and estate tax laws. So what do you want to do if you're not comfortable giving all of that away with the idea that you may need it in the future? And that's where this idea of a SLAT comes into play. So we love acronyms in the estate planning world. This is an acronym for a spousal lifetime access trust. It's a fancy name for a specific type of trust. It's a trust that you would create, irrevocable trust. You transfer assets to it during your lifetime. Your spouse, though, is a beneficiary of that trust, and your descendants, your children and grandchildren, could be beneficiaries of that trust as well. So you make a gift, you transfer assets out, you get all of the benefits of taking advantage of the current estate tax laws. But if you ever need those assets in the future, the individual that you designate to serve as trustee has the ability to get assets back to your spouse as a beneficiary. In addition, assets that you transfer to an irrevocable trust are protected from the claims of the beneficiary's creditors. They're protected from the claims from ex-spouses in the event of a divorce, and they're also protected from claims of the grantor's creditors. Bridget, if we could go to the next slide. Let's talk a little bit more about the benefits of a SLAT. So, irrevocable trust, assets that you transfer to the trust, and all the appreciation on those assets is outside of your estate for estate tax purposes. So you can transfer assets to that trust today, you use some exemption, those assets are out of your estate regardless of what happens to the estate tax laws in 2021. Your spouse can be a beneficiary and trustee of the trust. So I create an irrevocable trust. I name my wife as the trustee. I name my wife as the beneficiary. I make a gift to that trust. Those assets are outside of my estate. But guess what? If my wife ever needs those assets to live on, she's a beneficiary. She can distribute them out to herself. And then finally, I can create a trust for my wife and kids and use my exemption. My wife can do the same thing for me, create a trust for my benefit and use her estate tax exemption. So, Bridget, if you could go to the next slide. A few other minor points here. We always try to coordinate the provisions of irrevocable trust with your core documents to keep things as simple as we can. Typically, these types of trusts are classified as grantor trusts as well. And this means that while you've given assets to the trust and you no longer own them, you're still treated as the owner of the trust for income tax purposes. I know that seems crazy. Why would I still pay the income taxes if I've given the asset away? And the answer to that is by paying the income taxes on behalf of the trust, you're essentially making a tax-free gift to that trust every year without using any of your gift exemption. And if you ever decide you don't want to pay the taxes anymore, we always put provisions in the agreements so that you can turn off grantor trust status, at which point the trust pays its own tax. If we could go to the next slide, we've got a couple of graphics here to try to help illustrate how these trusts work. So again, husband creates a trust for wife. Wife can be the trustee. Wife can be a beneficiary. wife creates a trust for husband. Husband could be the trustee and husband could be a beneficiary. So by creating these two trusts and transferring assets to the trusts, you could transfer over $23 million out of your estate tax-free this year and still have the ability to access that $23 million of assets in the future if you need to, even though the estate tax laws could change. So because of that, because of the estate tax benefits and the creditor benefits and the ability to access those assets, I'd say a lot of clients who may not be in the taxable estate area right now today, but could be in a taxable estate situation if the Democrats win and there's a blue wave in a couple of weeks, are looking very closely at this type of planning. So what are the risks of engaging in this type of planning? The first would be if one spouse dies, now you've lost your beneficiary of that trust. So I create a trust for my wife is a beneficiary. There's an indirect benefit there if she receives distributions from the trust, indirect to me. If she passes away, the surviving spouse has lost any ability to access those assets. So the individuals, the husband and wife who engage in this type of planning have to be very careful about how much they put into these trusts, and they have to know that you could lose access to those assets. Divorce is always an issue as well. These are irrevocable gifts to irrevocable trusts. You cannot undo the transaction in a few years if the marriage goes south. And then finally, there's an issue with the reciprocal trust doctrine. That's a legal doctrine that says that if husband creates a trust for wife and wife creates an identical trust for husband, neither of them have really given anything away. They both have the same interest of what they gave away to the other person, and therefore the transfer should not be respected. We can avoid the imposition of the reciprocal trust doctrine by making the trusts different. So maybe different trustees, different beneficiaries, different distribution standards. You just have to make sure that the trusts aren't identical. Bridget, if we could go to the next slide, I've just got a couple more graphics here. So here we've got an example of a transfer of non-voting stock in a closely held company to these types of trusts. But at the end of the day, you could give away whatever you want. You could give away non-voting shares of a closely held company. You could give away cash, marketable securities, real estate, any assets that you own could go into these trusts. So husband creates a trust for wife, wife creates a trust for husband. We can go to the next slide. Okay, and if you could click one more time. So here your family business is now owned by these trusts. Distributions are made from the business to the trusts. And now you've got cash at the level of the trusts that's not in husband's and wife's name or available to them. You can go ahead and click through two more times. What we can do next is have distributions go from the trust that husband creates for wife and the trust that wife creates for husband to their respective spouse. So again, the idea is that we're getting assets out of the estate, but we're not negatively impacting the client's financial security by engaging in estate planning this year. The only other thing I guess I would say is, if there is some sort of a sale of the family business to a third party, the shares would go from, or the proceeds would go from the business into the trusts, and it would operate the same way. We can go to the next slide. So I'm going to go through this section relatively quickly. in the interest of time. But this is about what type of assets do you put in the trust? And if you think about it, what we typically try to do is depress the value of the assets that you put in the trust at the beginning. So not only do you get all the future growth out of your estate, but you also get that delta between the fair market value to a third party potentially and the discounted value out of your estate as well. So how do you determine fair market value? If it's stock in a publicly traded security, it's very easy to determine value. It's much more difficult when you start to look at interests in closely held entities. And so what we do is look for ways to argue that what you own is worth less than its, say, percentage of the whole. We can go to the next slide. So the key techniques, first would be to fractionalize ownership, to create minority interest discounts, and to create non-voting stock to create lack of control discounts. The idea behind these types of discounts is that if you're given, or if you're going to buy a minority interest in a closely held company, what are you getting? You're getting an asset that you can't control, and you're getting an asset that there is no ready market if you want to sell it. And because of that, that asset is probably worth less than its percentage of the whole entity. So that's what we do to minority interest discounts, lack of control discounts. If you don't have an entity in place already, you can create one. That's typically called a family limited partnership. The other technique to this would be fractionalizing ownership in real estate as well. We can go to the next slide. And so a family limited partnership, essentially, it's the same thought process. Your general partner runs the partnership. Your limited partner has no control rights. Because of that, limited partnership interests are worth less than the general partnership interests. So what we oftentimes do is create these types of entities and transfer those limited partner interests to trusts for the benefit of descendants. Okay, so once you've engaged in the type of planning where you're transferring assets and trying to take advantage of the current estate tax laws, what else can you do? The next step is to make sure that there's liquidity available to pay the tax. And life insurance is a great vehicle to pay estate taxes or provide liquidity to pay estate taxes. And if you are going to use life insurance for that purpose, we would typically recommend that you purchase that insurance in an irrevocable trust, an ILIT or life insurance trust. Having life insurance in a trust is beneficial because, first of all, the life insurance proceeds won't be included in your estate for tax purposes. Secondly, the trustee can manage those policy proceeds and make sure that they're used for the proper purpose. We can go to the next slide. The life insurance proceeds that come into the trust can be used to pay estate taxes. That's the cash that has to be paid within 9 months after the second spouse's passing. And then again, we always want to make sure that the provisions of the trust are coordinated with your other estate planning documents. We can go to the next slide. So, what are clients actually doing today? It's kind of crazy because estate planning is not a topic that you hear about in the news, or at least we haven't since 2012. And now we're starting to see it pop up, and I'm seeing articles in really widely read publications about things like slats, about those types of techniques. Clients who understand that clients understand that these exemptions could go away very quickly. And because of that, a lot of our clients are planning with urgency today. A lot of clients are engaging in this type of planning, even if the Democrats do not retake control of the federal government because they know that the current estate tax laws are going to sunset in 2026. And I think we can all agree that the government is going to need more revenue, and that revenue is likely going to come from the wealthier individuals. So that's going to be taxes on estates and high earners. So clients are planning. What are they doing? They're creating new trusts like the slats that we were talking about. They're creating trusts for the benefit of their children and grandchildren. If they have trusts that they may have created in the past, clients are making additional gifts to those existing trusts, again, moving assets out of their estate today while they know that the estate tax laws are favorable. None of us know exactly what's going to happen in the future. What else? So we have this big exemption amount. So when tax reform was passed a couple of years ago, the exemption amount doubled. It's tied to inflation. It's up to $11.58 million per person this year. What can you do to use that exemption knowing that you might lose it? First of all, if you've made a loan to your kids, if you've helped them buy a house, which a lot of our clients have done, they're forgiving those promissory notes. That's a gift, but it's just going to use up some of the exemption that may not be there in the future. Similarly, for clients who have created these life insurance trusts in the past, typically contributions are made to those trusts every year to pay the life insurance premiums when they're due. One thing that you could do is pre-fund those life insurance premiums. So go ahead and put 5 years of premiums into that islet, so you know that you've got cash available to pay that premium. If the laws change and for some reason you can't get additional contributions into the trust, or you just don't want to deal with the administrative burden of making contributions into that trust every year. You don't want to deal with the administrative burden of your kids paying you back for the loan that you made them. Use that exemption to simplify your estate plan. And then finally, we could go to the next slide. This is where things can get kind of exciting from my standpoint. But once you've got assets in these types of trusts, and you know that these assets can grow indefinitely without being subject to estate taxes in the future, use the trust as the primary investment vehicle going forward. Invest in new opportunities through the trust as opposed to using your own assets outside of the trust. Keep all of that growth outside of your estate. And then finally, I think we're seeing this more and more. Clients are holding family meetings. They're talking to their kids about the succession plan. They're talking to their kids about the estate plan. It's the idea of setting expectations, telling your children this is what our goals are and this is what our expectations are for inherited wealth and its role in your life. I think from my perspective, some of the most successful succession planning that we've done with families were those families who are open to having these types of discussions. So that's the end of my prepared remarks, kind of a crash course on things you can do today before the end of the year. And maybe Art and Jeff, we can open it up to questions.
That was a great presentation, Rhett. Thank you very, very much. You really hit on a lot of excellent topics. And
thank you, Art. Appreciate that.
One of the questions that came in, somebody has a life insurance policy that they own, and their wife and their children are the beneficiary of it. They wanted to know how they transfer that to the ILIT, the Irrevocable Life Insurance Trust.
Okay, that's a great question. So first of all, why do you want to transfer it to the ILIT, and then how do you do it? So you want to transfer it to the ILIT so you can get those life insurance proceeds outside of your estate for tax purposes. So if you've got a $5 million policy and you own it and you pass away at a 40% tax rate, that's $2 million of that life insurance proceeds that has to go to the government. Move it over to an ILIT so the full $5 million is available and none of that goes to the government. The way to do that is to create the trust and then assign your ownership in the policy to the trust. That's a taxable gift this year. So the value of the policy is going to have to be reported on a gift tax return, and that uses some of your exemption. The only hitch here is that there's a 3-year look back on life insurance policy transfers. So if you don't live for 3 years after you transfer the policy proceeds will still be included in your estate for tax purposes. If you live past that 3-year period, then you're past the window and you won't have to worry about that. So logistically, it's not a big problem. It's what's getting the trust in place, and then it's as simple as an ownership change, and then you have to report the value on a gift tax return.
Okay, thank you. Then there's a question to both of you, wondering if they make lifetime gifts under the current limits and Congress comes back and changes those limits so that they're lower than where they are now. What happens to those gifts? Are they nullified, or are they taxed after the fact? So either one of you.
Brett, I will defer to you.
Well, this is an interesting one. And let me take it in 2 steps. So first of all, let's say that there is this blue wave in November. That means that the President Biden, he's not going to be president on January 1st. He has to wait until he's actually inaugurated and the new Congress takes control. And then they're going to have to pass tax legislation. So the tax legislation is not going to be passed until some point next year. The issue is that in all likelihood, they're going to make it retroactive to January 1st of 2021. So if there's the blue wave and we all anticipate that the laws are going to change, I think we all also have to anticipate that the effective date is going to be January 1st of 2021, even though the law isn't passed until later. Now to get to your actual question, the laws in place this year are effective regardless of what happens next year. And so as it's occurred in the past, I don't anticipate that there's going to be any sort of a clawback for gifts that are made in 2020 after the tax laws change. And there's certainly a constitutional issue of passing retroactive tax law that goes past or prior to January 1st of 2021.
Okay.
So short answer, I think clients are planning with laws as they are today, and the consensus is that there's not a major concern that there'd be an issue with the effectiveness of gifts that you make today using the laws that are in effect today.
And you notice how Jeff passed that to you because we don't give legal or tax advice.
Oh, nice.
We
Okay.
listen to the disclosure that I read. Okay. Another question. If I'm not sure my children actually want to return to the farm and I put the ground in a slat, what happens if they don't come back? And my wife and I have passed on.
Well, that's a great question. I think that you're going to have that same issue regardless of whether or not you actually transfer the farm into the slat. If you pass and the property is in the trust, then it's up to the trustee to determine whether that property should be held for the family or sold to a third party, at which point the proceeds would be distributed to the trust.
Okay. We're somebody who's on the phone wrote in and wondered if you have any advice for income taxes this year. We're talking about estate transfer and things like that, but is there anything that we should be looking at this year in anticipation that income tax rates might go up in the future?
Yeah, we were just talking about that before the call. Jeff, do you want to tackle this one, or do you want me to take it?
Well, I'll offer a couple of thoughts, and then you can offer some as well.
Okay.
I think the most important thing is talk to your tax advisors. Talk to your accountants, see what types of things they are thinking about, because they certainly know your situation better than we do. But some of the things that we are seeing clients do, kind of counterintuitively. Historically, we've always deferred income, push it out into a later tax year. But now we're sitting here going, we may have higher income tax rates in 2021 than we do this year. So maybe we should accelerate some income into 2020. Now that gets really complicated, especially with all of the questions swirling around the PPP program and every other crazy thing that's happened this year. But it's worth having that conversation with your accountant to say, should we accelerate some things this year? Another example of that, we have a lot of clients who are doing Roth conversions for their IRAs and other retirement plan assets. Roth conversion means you take an account that accumulates tax deferred and you pay taxes on it down the road when you take the money out. And you actually convert that to an account where you would not pay income tax down the road, but you do pay income tax when you do the conversion. So it's not a question with a simple answer. You have to do the analysis. But in some circumstances, if income tax rates are going to be higher a year from now or 10 years from now, it might make sense to convert that IRA to a Roth IRA today. And there are also some more esoteric issues. For example, we have clients who do 1031 exchanges when they buy and sell properties. A 1031 exchange is basically a way that you can defer paying income tax on a property that you are selling today because you're turning around and you're buying a different property. Kind of an unheralded bit of the Biden Green Book proposal is to do away with those 1031 exchanges. So if you're in a situation where you're thinking about, am I going to buy some property? Am I going to sell some property? Am I going to swap that property? You should huddle with your tax advisors before the end of the year. And if your tax advisors, don't really have an answer, Red has got a fabulous team, and I'm sure he would be more than willing to help you out there. So, Red, I'll toss it back to you.
Yeah, obviously. The only thing I'd say in addition to that is that it's exactly right. Clients are looking to accelerate income into 2020, just totally counterintuitive to what we've all done and been taught. And we're seeing it in the transaction space as well. So it's not only income that clients are trying to accelerate, but clients are accelerating their timeline for selling major assets as well, whether that's real estate or operating businesses.
And thank you for bringing that up. I will add to that. It is really a seller's marketplace right now for closely held businesses. We have these private equity groups that are sitting on the sidelines with trillion-dollar war chests looking for companies to buy. And particularly with all the volatility in traditional markets, there is a lot of money chasing deals. So if there's anyone on this call that's thinking, boy, I've kind of had it with COVID. This isn't fun like it used to be. Maybe I should sell my business. 2020 might be a really good time to do it. Now, there's not a whole lot of time left in the year, but between what we think will be lower income tax rates this year, plus this incredible demand that's out there in the marketplace, that's worth thinking about.
Yep, I agree wholeheartedly.
We've got two more questions. This one deals with someone who had an uncle that did a trust, and a bank or a trust company was involved, and I guess it didn't go well. Anyone want to comment on that?
Well, in my former life, I did work in a bank trust department, so that was way before law school. But I guess, from corporate trustees certainly serve a purpose, but they're not required in every instance. And so there is no requirement that you have a bank or a trust company involved in the administration of your trusts or estates. And like I said in the part of the presentation about slats, you can name your spouse to serve as trustee of an irrevocable trust that you create. The limitation is just that you can't be your own trustee of that trust.
Okay. And then the last question is, and we're open to more questions if people want to send some in. A lot of ideas have been talked about today. Is there one that you favor over another of the things that you've discussed, Rhett?
I guess from my perspective, my client's own personal financial security is my first priority. And then we go from there in terms of planning techniques. And so the SLAT does provide some additional security to clients. Obviously, the planning process is personal to everyone. And, my advice to clients changes depending on the financial circumstances and the personal circumstances. I think it's the client's financial security, and it's trying to keep flexibility of the plan.
Jeff, would you like to weigh in on that too?
Yeah, and I'll just echo what Rhett said. We have clients who are very aggressive. They're gunslingers. They hate paying taxes. They will do anything they possibly can, regardless of how complex it might be, to disinherit Uncle Sam from their estate. But we have other clients who say, I want to take my grandkids fishing. I don't want to get involved in this big, elaborate planning process. I'm going to have some taxes. I'll just buy some life insurance. That's okay. There's no right answer here. So the answer to your question, Art, is it depends. The client needs to have a team of advisors who understands their unique circumstances, their family dynamics, their temperament, their risk tolerance. And with those inputs, every plan tends to be a little bit different from the plan before. And frankly, that makes it fun for those of us who do this.
And I think that we kind of have an unwritten rule that we do not want to see our clients, the IRS commissioner versus clients. We don't want to make them famous.
Great point.
So, are there any wrap-up comments that you all want to make? You've been great today. Thank you.
Oh, I'm just happy to be here. Thanks for having me.
We appreciate everybody participating, and as Tamas said, this will be on the please don't hesitate to give any of us a phone call should you have questions, or shoot us an email. We've got our contact information here, and we really appreciate you all taking the time. Tamas, you want to say something?
I just want to thank you all. I think this was extremely helpful and beneficial to our industry. I assume we'll know a lot more shortly after November 3rd, but maybe not. Time will tell. I do appreciate this last slide. If folks want to quickly jot down some of these emails and phone numbers, I think that would be great. I know when it's when there's a group setting like this, some people are reluctant to ask their individual questions.
Sure.
And so I think it'd be helpful if they want to reach out to you directly, if you're receptive to that. We'll certainly encourage our members to do that. And yes, you pointed out that we will be posting the video on the WisconsinPotatoes.com website just as soon as it's available. You could probably check back next Wednesday or Thursday on our website and it'll be posted. But beyond that, no, Rhett, Art, Jeff, it's been great. Thank you very much. Thank you to all our participants. I'm really pleased with the number of you that showed up. And hopefully we'll get even more views of the recording. So,
Great. Thanks for the opportunity, Tamas.
Stay healthy, everyone.
Bye-bye.
Have a great day.